I'm joined by Lee Bartholomew, Head of Derivatives Product R&D for Fixed Income at Eurex. Lee, welcome back to Trader TV.
Thank you very much for having me. It's a pleasure to be back.
So tell me, if buy-side traders are finding liquidity and price formation difficult in over-the-counter cash markets, what are their alternatives?
The heterogeneity of bonds means that it's unable to achieve that optimal model that you see in the equity market. So I think the way that the markets evolve, and by the markets I mean the different segments of the different players, means that electronification is definitely playing a more pivotal role in the use of a trader's toolkits, in essence. So the electronification means that platforms have obviously seen an opportunity to grow. You've then got the traditional role of an exchange, which has been largely to be the point of contact in terms of alternative liquidity pools, and that's largely in the listed space, whether that's futures or options or index-based products or options on those index-based products. And I think what you're now seeing is in the cash market, the liquidity has been split across various platforms. Now what you see in the exchange world is you have key players that have always been able to provide buckets of liquidity in their core franchises. You're seeing the buy side, now that we're looking at electronification and banks are under increasing pressure on their balance sheets and margins given the rate environment, are looking to say, we want to see more fungibility across the product suite. What will be the drivers will be the ability of those exchanges plus the sell side to offer cross-product margining.
Trading in those liquidity pools, what difference does that make if bank balance sheet, for example, is very limited?
For the buy side, what they need to see is liquidity. When they're looking at developing their technology and moving into execution, then you have to look at the full system that they're using and then what tools do they have available on a desk level, and then where do those liquidity triggers point into, and what is the most important factor for them? Is it cost of execution? Is it liquidity, number one, or is it cross-product margining? And I think those are the three areas which are the most interesting both to the buy side and the sell side going forward.
Is it challenging for traders to work across both the listed and the OTC range of instruments?
It's what products can an exchange or alternative providers create in which you replicate some of that OTC risk. ETFs would be a prime example of that. So you can trade, I think you can either trade the underlying cash bonds, you can trade the ETF, you can trade options on the ETF, or what you're seeing is people trading index-based products or a portfolio of bonds. I think that is where the market pushes to going forward.
Yeah. Lee, that's been great.
Thank you.